Hello again, fellow BeachBum traders. Thank you for joining us for part one of our weekly trading game plan for the trading week of March 18th through March 22nd, where we'll try to see when will the Fed start cutting rates now. So thank you again for joining us for part one of our weekly trading game plan for March 18th through March 22nd. So let's get started. Here's our Google document with our notes for our weekly trading game plan, part one for the trading week of March 18th through March 22nd. We keep our notes for our weekly trading game plans in publicly accessible Google documents, so you can refer back to the notes for this week as well as previous weeks. We store our notes for our weekly trading game plans in a publicly accessible Google Drive folder. So again, you can refer back to the notes for this week as well as previous weeks, and you can find direct links both to these this Google document and our Google Drive folder in the description box below. Good morning, Brian Moritz, MD. Thank you for joining us in the live chat today. Hope you all are doing well. So we'll start out looking at how the markets ended up on Friday in FinViz. So we'll go to the main page of FinViz. See, the markets all were down on Friday. So Friday was quad witching, so higher volatility, probably some profit taking, some selling off into Friday. And into the quad witching, we see the Magnificent Seven, profit taking in the Magnificent Seven. Most of the sectors were generally red, had a little green in financials, healthcare, industrials. See, we had 46% declining, 48% declining, 47% advancing, 52% new highs, 47% new lows. Got 60% above their 50-day moving average, 40% below, 65% above their 200-day, 34% below. So even though this shows a little bit bullish, I think overall the day was generally bearish. Look at some of the news. U.S. economy scores a win from the bear market natural gas. So we'll look at the rollover in natural gas. Huawei delays will be resolved. Home buyers, no more 6% home buyers. Indices finish week with decline. We talk about Adobe. And S&P closes lower on inflation worries. We'll talk about the CPI and the PPI data that we got. We saw oil pop up over 80. I think it might have gotten tested almost close to 82. Got rejected from that. Now it looks like it's, we'll see if it holds that support over 80. Natural gas, again, kind of popped up and rolled over. Gold, as we'll see in the future, seems to be consolidating around that 2150 level. And we'll also see it looks like there's a catch-up trade in silver. See all the indices currently pointing down, with the NASDAQ being the most severe. Foreign currencies, the DXY popped up into the 103s. It had dropped below 103 briefly. And we see the Treasury yields pop back up. So now we got the 30-year at 4.4, the 10 and 5s in the 4.3s, and we see a slight inversion in that 5 to 10 Treasury yield. But again, that surge in Treasury yield, so drop in Treasury prices, as we'll see. And again, in my humble opinion, this was caused eventually the slightly hot CPI and PPI data finally sunk into the market, and the bond yields popped up, and the markets kind of rolled over. Welcome, Easy Mike, to Ricky Khan. Thank you for joining us. Alan Krantz. Hope you all are doing well. Okay, so we'll also look at the major indices and the technology components. Again, just a quick reminder, you can find these links in the notes documents and also in the screeners tab in both our ETF and Watchlist Google Sheets for, quick access. So if we look at the major indices, we see the Dow again getting rejected off that upper trend line. It did break down over that very narrowing wedge of an upper trend, so broke down, headed down towards its moving average. So again, Dow rolled over. Russell, again, the Russell is small caps and much more sensitive to needing rate cuts. And we'll talk about, again, when will the Fed start cutting rates. So when that sunk in, that the hot CPI and PPI probably meant the Fed's not going to cut anytime soon. Again, that the small caps, the Russell really needs those rate cuts. So we see it broke down below that supporting trend line and headed down to its moving average. So again, I expect more downside on the IWM, more downside a little bit on the Dow. See the Qs also broke down through its upwardly trending channel. Looks like it's going to test and possibly gap fill that support area. So again, some potential more downside in the Qs, to fill that gap. SPY seems a little bit stronger. Again, it keeps testing that upper trend line. Looks like it's got pretty good support in this area. However, we do have this gap as well in the SPY. So if we get if it doesn't hold that support level, we'll probably get a gap fill and a quick drop down to that previous support level. So again, a lot of downside risk in all of the major indices. Again, in my humble opinion, I think particularly the SPY is being held up by the Magnificent Seven, and we keep seeing this rotation in and out of the Magnificent Seven, and they're typically seen as a flight to safety. So again, part of the flight to safety trend is going back into the Magnificent Seven, particularly stocks like Microsoft, back into NVIDIA. Not so much Apple, but some of the other Meta, some of the other Magnificent Seven. So if we look at the technology components, again, we see ARKs just kind of oscillating. This is the ARK-K getting support from its moving average, getting rejected off that upper trend line. Did break down out of that wedge. I don't see ARK-K going anywhere. It's just oscillating, trading sideways. Again, we see the FANG stocks again broke down more so. So there's other things in FANG U other than just the Magnificent Seven. So it's a little more sensitive. Again, more downside in the FANG U down to this support level, down to these moving averages. So distinctive rollover in the FANG U. Biotechs, again, we looked at this last week and saw this, steep downward trend, getting some volatility, some support out of that lower trend line, but it did break down below that. We've got support from the moving average. Even semiconductors broke down, got rejected off that upper trend line, headed down to its support at the lower trend line. So again, I expect it to get to test that lower trend line, probably get some support, potentially bounce back up. We'll also talk about the NVIDIA Developers Conference starting this week. Again, in my humble opinion, that's going to cause a resurgence in the AI FOMO. So expect a bounce in SOXL. The broad technology, again, it's more broad, so it's been just kind of oscillating within this channel. Again, we'd have to see, more downward pressure, more sell-off in some of the Magnificent Seven or a broader sell-off in tech, but we'll probably see eventually a test of that lower trend line. If it breaks down, then we'll see a test of that 70 level. So again, broader technology. Qs, again, a little bit weaker. Looks like the NASDAQ, it broke down out of its channel. Probably get support from that moving average. We do have this, gap to further fill. Looks like we're in the gap. Looks like we need to come down and test that gap fill. So again, some potential more downside in the Qs, the broader technology, and probably TECL. So again, technology seems like, we'll see this in the industries and groups as well. Seems like we're finally getting a rotation out of technology in general. However, again, the buy the dippers in the Mag 7 and in semiconductors will continue, in my humble opinion, to buoy those areas up. Just a quick reminder, none of this should be considered financial advice. We're not financial advisors. All of our content should be considered for education and hopefully some entertainment purposes only. Welcome, Gerald Fitz, The Crow, Brian Moritz, if I missed you earlier. So thank you all for joining us in the chat. Hope you all are doing well. So let me grab a quick drink and we'll look at the groups, sectors, industries, etc. Also in FinBiz, see that sector rotation. Okay, if we look at the groups, the sectors in FinBiz, again, we see that rotation out of technology into some of the other beaten down flight to safety sectors on Friday. So basic materials, industrials, energy. Again, industrials have been relatively strong for quite some period of time. Talk about potential rotation out of industrials, profit taking there. Again, basic materials had a bounce back. Again, the weakest were technology related. So for the week, energy, again, oil back up over 80. Natural gas did pop up and rolled over. Again, basic materials, I think this communication services is mostly related to those that got a positive boost from the potential TikTok legislation. See, the weakest is real estate. Again, anything that was bond yield sensitive going to have some weakness. So that pop back up in the bond yields definitely had a negative impact on real estate. For the month, again, we see a rotation back into energy, utilities, industrial, basic materials. So again, we've been talking and looking for this kind of rotation for quite some time. Again, rotation out of technology back into energy, basic materials. We'll see some of the top gainers for Friday were basic materials and energy related. For 3 months, so technologies was strong. So again, it's only this month we're starting to see that rotation happen out of technology in general. Again, utilities are sensitive to rates. So if the Fed's not going to cut soon, that may negatively impact utilities, real estate, etc. So if we look at the industries, again, the top 3 performers from Friday were copper, silver, and uranium. Some oils, so quite a few oils, mixture of REITs, rebounding coke and coal, although we'll see that coal's been kind of weak. Gold slightly negative. Again, we'll see, I think gold's just consolidating right now. Solar, very negative reaction to, interest rates. So the higher for longer, it's very negative for solar. Software, again, technology. So for the week, copper had a nice rebound, silver a nice rebound. I think there's a nice catch-up trade in silver, oil rebounding up over 80 again. Gold slightly positive. Big negative. Solar, again, coke and coal was very negative for the week, had a slight rebound on Friday. Again, REITs are interest rate, mortgage rate sensitive, so that was negative for them. Again, for the month, basic materials, gold, silver, copper, oil. So again, your commodities now are all rebounding, and again, a rotation out of technology into things like energy and basic materials. So again, I think that's going to continue to be the theme, other than the buy the dipping on the Magnificent Seven. So again, uranium was negative for the month, but we saw, that bounce, that recovery back on Friday and this week. So again, I think uranium's bouncing back up. Welcome, Sydney Osborne. Glad to see you. Thank you for all of your support, ongoing support. I appreciate it, Sydney. So let me grab a quick drink. I'll open up the investing economic calendar in Investingcom. We'll look over my notes for the important economic data from the past week, and then we'll also look at the upcoming economic data for next week, including when the Fed's going to release their interest rate decision, etc. So Okay, just a quick reminder. I try to post this economic data, important economic data, as quickly as possible when it comes out in the Surf the Markets channel in our Discord. Our Discord is free to join. You can find an invite to our Discord in the description box below. So again, you can see as quickly as possible. I try to take a snapshot of the important economic data from Investingcom and also post the raw text and also any news from various sources as that economic data comes out. So highly encourage you to join our Discord. You can also carry on conversations regarding anything related to trading, stocks, the markets, etc. In the various channels in our free Discord. So again, hope to see you there as well. Didn't have much from Monday. Tuesday, again, we got the core CPI data. CPI data was slightly hotter than expected. So we could see 0.4 versus 0.3 month on month, 3.8 versus 3.7 year on year. So again, slightly hotter than expected. Real earnings was flat. So it was previously negative. Now it's flat. So again, this CPI data was slightly hotter than expected. And the market really didn't negatively react to this CPI data right away, as one would expect. Again, the AI FOMO, the technology FOMO, and all the, generally people wanting, to the FOMO into the market. So it didn't really negatively react to that hot CPI data initially. Then Wednesday, not much. And then Thursday, we got the PPI and the jobless claims data. And again, the PPI. So both ends of the inflationary curve were hotter than expected. So core PPI 0.3 versus 0.2. PPI month on month was double that expected. So 0.6 versus 0.3. Year on year, 1.6 versus 1.1. So again, inflation on the front end of the curve, PPI much hotter than expected. And initially, again, the market seemed to want to try to shrug that off, but then it rolled over once that's started to sink in. And again, we'll see what effect that had on the predictions for when the Fed will start cutting rates. Continuing jobless claims, lower than expected, higher than previous, but lower than expected. Initial, again, lower than expected and lower than previous. So fewer people, losing jobs. Some people are getting jobs. So the job market continues to be resilient. So in the Fed's battle of inflation while maintaining full employment, they can focus on inflation, and it doesn't look like, we talked several weeks ago, inflation's still smoldering, and it definitely doesn't look like they've beaten inflation yet. Okay, Friday was OPEX, quad witching. So we had all the futures and options contracts expire on Friday. So again, probably part of the reason for the sell-off, people wanting to get out before that quad witching, as well as it being a Friday before a weekend. So in a second, we'll go and look at the economic data from this week and also what's coming up next week. Just some quick notes. On Monday, the NVIDIA Developers Conference starts. A lot of people are looking to that. Jensen Huang has I think it's a 2-hour initial speech. I expect a lot of excitement, a lot of FOMO, AI FOMO coming out of that, a lot of predictions, etc. So again, I think that's going to rekindle the AI semiconductor FOMO due to that developers conference. Then Wednesday at 2, we get the Fed's interest rate decision. We also get an SEP, so a summary of economic projections, so what they call the dot plot. So this will be very important as to determining when will the Fed start cutting rates. We'll see if there's a significant shift in the dot plot. Are they still predicting 3 for the year? When might the first one come? We don't expect them to change interest rates this meeting. Again, I don't expect them to cut, don't expect them to hike. I think they'll stay at 5.5. And what will be significantly interesting is do the dots move at all? And also, what does Fed Chair Powell say at 2:30 in his press conference in terms of when their expectations to start cutting will be? So we'll look at the rest of the economic data in Investingcom. So we got bond auctions seem okay. Again, Tuesday we got CPI data. Crude oil stocks down. So along with that, the conflicts in the Gulf, it sent oil prices. Also, there was a IEA report of higher than expected demand. I guess a deficit in oil. We also heard Ukraine bomb several of the Russian refineries, which does take their supply, even though there's restrictions on their sale. We know India and China have been buying Russian oil, so reduction in that. They'll have to buy it on the market, increased demand. So oil again popped up over 80. So Wednesday, mortgage rates 7.1, so it had dropped. 6.8, so it had dropped. I expect those to go back up with the bond yields, 10-year bond yield going back up to the 4.3s. Talked about PPI and jobless claims. We didn't talk about retail sales. So retail sales was slightly weaker than expected. It was positive, but weaker than expected in February. So I guess Valentine's Day wasn't as strong as they had expected, possibly due to the increased cost in chocolate and cocoa. It might impact their Easter sales as well. Your chocolate bunnies are going to be a lot more expensive. Welcome, Douglas PC. Glad to see you. Thank you for joining us. Import-export. On Friday, I want to look at the Michigan sentiment. So we also got Michigan sentiment data on Friday. So you can see the one-year inflation, although it was lower than expected, it's still in the 3% range. 5-year inflation expectations, it's been steady at 2.9, so still pretty high. Expectations were lower than expected. Sentiment lower than expected. So again, the consumer is still expecting pretty high inflation, not feeling quite as good, although their current conditions a little better than expected, but flat from previous. So no change from their previous reporting. So again, high inflation, a little weaker sentiment. So that's also something that the Fed will be looking at. And it looks, right now the consumer's anchoring inflation pretty close to 3%. They want them to anchor at 2%. So they're going to have to do something to make that happen. Oil rig counts went up. Total rig counts went up. So again, with the higher prices, it looks like the oil companies are trying to cash in on the higher prices while they can. So that's positive for the oil companies. So let's look at next week. So Tuesday, building permits, housing starts. I personally expect that to slow down due to mortgage rates. Also, the higher for longer. Refinancing your mortgage. You won't be able to do that as quickly. Got bond auctions, crude oil stocks, mortgage data on Wednesday. Again, everybody's going to be waiting to see the dot plot. So at 2, we get the dot plot, the SEP. We get their Fed interest rate decision. As you can see, it's expected to be steady at 5.5. But again, everyone will be on watching and listening to what Powell actually says in terms of when are they going to cut, how fast are they going to cut, how much are they going to cut. When we get to the theme for this week and look at the actual projections for interest rates going forward, I'll talk about my personal opinion as to when I think they'll cut and by how much. Thursday, again, we'll get jobless claims data. So manufacturing data, homes data, natural gas storage, Baker Hughes, and then we got Fed officials already coming out and starting talking. So right after they make their decision, then we get the wave of Fed officials voicing their opinions as to what their decision was. Were they in consensus? What do they all think? Causing some level of volatility. So again, we still have some earnings, so you can see who's left for earnings. Although, most of the major companies have reported. Looks like we've got some banks. You can go through the list, see who's reporting earnings. If that'll have, it looks like we've got some energy companies. So again, you can keep an eye on who's reporting earnings and how that might affect your portfolio and or trading decisions. Again, you can hear how we trade around earnings via the link to that video in our notes. Again, you've seen with companies like Adobe, even though their earnings were pretty good, their guidance was poor. Also, I think it was Ultra Beauty, increased competition. Adobe definitely got hit on their forward guidance, their competitiveness in the AI space. So again, you need to also listen to their earnings, their guidance, as well as what are they saying going forward. So let me grab a drink and we'll look at the market screen in Webull. Just a quick reminder, if you're not already using Webull, you can still get 75 free fractional shares of stock by opening an account, funding it with 25K or more. If you fund your account with less than 25K, you get 20 free fractional shares of stock, each worth $3,000 to $3,000. If you'd please use our affiliate link in the description box below, you can get your free fractional shares of stock as well as help support our BeachBum trading community. Also, just a note, I've seen several promotions, and I'll try to capture those and share those, that they're offering a match on deposits into an IRA account, which is quite interesting, essentially free money. So again, I'll try to capture that promotion and share it with you all. But again, it might be a great time to open an account in Webull, get that match in your IRA account if you're not already using Webull. So here's the market screen of the online browser version of Webull. So we can see from Friday, even though it was generally a down day, we did have more advancers than decliners. So that's interesting, a broadening of the market. Again, I think the indices are being, mostly driven by the Magnificent Seven. So here we see, we get some broadening, some more advancers than decliners. So again, I think the indices being driven, just by the Magnificent Seven, mega cap techs. So as we've seen, NYSE typically gets this inflow, although it's much less on Friday than typical, and the outflow out of the NASDAQ. So again, for several weeks, we've seen this outflow of money, profit taking in the NASDAQ, in the Magnificent Seven. So again, that's a trend that you might be able to make money trading, is profit taking in the Mag 7 in the NASDAQ on Fridays. So again, you can see the near-term earnings calendar here in the calendar tab under earnings. You can also see dividends, splits, etc. here in the market screen in Webull. Also added this heat map so you can explore that. I want to look at the best performing industries for the week. So we see the top was oil and gas, transports, government. Looks skewed. Oil, again, oil, healthcare split, food kind of split. Again, use metal and mining positive. So again, you don't see technology up near the top from this past week. It's mostly basic materials, energy. So again, not technology this week. So if we look at the ETFs, so down on the NASDAQ, pretty much, down on all the indices, down on the Dow, down on S&P, down on NASDAQ, up on the VIX. So we will, as we'll see in the futures, the VIX actually popped up into 15, quickly retreated down in the 14s. This is showing up on the Russell, so maybe a bounce in the Russell, bounce in small caps. TNA is a long on small caps. Industries, again, uranium, copper. Industrial, still relatively strong. Healthcare, financials, utilities. Very negative in communication services, positive in energy, mixed in real estate, very positive in basic materials, negative in technology, negative in cyclicals, mostly negative in cyclicals, mostly positive in defensives. So again, contrary to last week, which was more of a risk on, this week was more of a risk off. There's one Easy Mike had been mentioning, DBA, agricultural products. So DBA, top performer this week. Okay, so we'll look at the futures. So again, all the indices we see pretty much, topped and rolled over. Again, we've got some gaps to fill in all of the indices. So downside risk. Again, the NASDAQ does have some, decent amount of support in that area. So again, we expect it to test that support, probably bounce just due to all the, exuberance in technology and AI. So I would expect a bounce in the NASDAQ from there. Again, you see that very negative reaction in the Russell when they figured out that they're not getting rate cuts anytime soon. Looks like they're trying to bounce it at that support level. But again, if the rate cuts get moved out, a lot of risk in the Russell. Nikkei rolled over. Looks like it's trying to gain some support. We'll see if it retests that high. If so, that's something we might be looking at. I guess there was a labor union decision. I think it was yesterday. Easy Mike probably knows a lot more about that than I do, and hopefully he can share the views coming out of that labor decision. Also, the Bank of Japan's talking about, getting out of negative rates. So we'll see what reaction that has on the Nikkei and the yen. Euro stocks have been relatively strong. Did roll over a little bit, but not quite so much as the US. DAX had a surge, so Europe stronger, in general. Again, we saw that pop up in the VIX into the 15s, very quick retreat back into the 14s. So it just not holding these pops. We see these really long wicks. So every pop is retracing pretty quickly. Also with quad witching, increased volatility. So we'll see if we get another quick pop on the Fed interest rate decision. Again, oil popped up over 80. I would expect it to test 80, and we'll see if that holds. Again, natural gas went up, tested 2, got rejected, coming down. We'll see if it tests its previous low. Again, if so, we're looking at another scalp swing position in oil, which is the leveraged long on natural gas. Seems to be, just kind of bouncing right now. Saw that big surge in gold, hit a new all-time high, and then got rejected off 2200, very near 2200, and again now seems to be consolidating around that 2150, which is very healthy. I think that's good. If we see this nice consolidation around 2150, we could see a swing back up in gold. If 2150 breaks down, then we could see a pretty significant fall in gold, which again might be an opportunity to short gold with some of the leveraged leveraged short ETFs that we have in our spreadsheet. Again, silver, in my humble opinion, catch up trade to gold. We talked about that for several weeks. I think this is a stronger opportunity as gold consolidates. I think we'll see more of a catch up in silver. We saw it pop up over 25. I expect, it may consolidate, fortify that support at 25, and then we might get another upturn in gold or in silver. Again, copper, big rebound in copper. Platinum and palladium bounced up, less so. Corn looks like it's rolling over, similar to wheat. It's just kind of oscillating. But again, we see that pop, run up in wheat, got rejected, trending back down. I think it's going to retest the previous low. Again, we traded this using the wheat ETF. We'll talk about that tomorrow. Took a small profit, try to get back in, a retest on that low. See cocoa's going nuts. Again, there's a shortage of cocoa out of West Africa, so all the chocolate prices are going way up. And we see this severe reversal in bonds and all the bonds. So yields went up, prices came down. In the shorter term bonds, we see these big gaps that could fill, may fill. So again, more downside in bond prices, particularly on the shorter ends, but even in the 10-year. So, we expect yields to push back up towards 5. It was surprising it took so long for that correction in bond yields. But again, finally, the inflation data seemed to sink in and bond yields went up, prices down. Again, we saw a bounce in the yen, a little bit of a correction. So again, we'll be seeing the correlation between that and the Nikkei as well. So a pair that we're looking at. Okay, we'll come back to our ETFs. I've got quite a few additions to talk about if we have time. So I want to make sure we get to our theme for this week and talk about when will the Fed start cutting rates now. So let me grab a drink and we'll look at both the Fed rate monitoring tool and the Fed watch tool and see when will the Fed start cutting rates now. Okay, again, our theme for this week is when will the Fed start cutting rates now? So we'll see what did the impact of the hotter than expected CPI and PPI have on the probability of rate cuts, rate hikes going forward in the future. So we'll look at both the Fed rate monitoring tool and the Fed CME Fed watch tool, which is typically what we use to look at the probabilities for rate hikes, rate cuts going forward. Just a quick reminder, you can find the links to these tools at any time in the reference link in the links section of our homepage. Our homepage is beachbumtrading.com, bum without the U. So again, you can find links to these tools as well as many of the tools we frequently use in the links section on our homepage. So again, a good resource for you to find and access those tools at any time. So we hope that all helps. We also have several videos on how to use the Fed rate monitoring tool and how to use the CME FedWatch tool. So you can listen to those videos and get more detailed instruction on how to use these tools. So again, we hope that helps. So look at the Fed rate monitoring tool first. You can see we got a countdown clock as to when the Fed rate decision is going to come out. You can see right now, as of March, it's 98% steady. So they already told us they weren't going to cut in March. It doesn't look like there's any probability of a rate hike. There's 2% of people that still insist that there's going to be a cut, even though they've been told there isn't going to be one. So let's go out to May. So now May, 94%, no cut, no hike. So holding through May, and we only have 6% people think there's still going to be a cut. Let's go out to June. We've still got 55% now at hold. So you remember earlier, the previous Fed interest rate decision, they were talking about a cut as early as March, and then they had subsequent cuts. They were guessing 6 or 7 cuts. Now only half the people think we're going to get a cut as of June. 41% hold still in June. 4% say you're going to get 50 basis points in June. Go out to July. Now we've got 48%, 0.25 cut, 30%. So 30% of people think we're going to get 2 cuts by then. But the majority say still 1. So 1 cut by July. Go out to September. Now we've got 2 cuts probably. Some people say 20% say 3, 30% say still 1. Go out to December. Now the majority has got two cuts, some 3. So again, the Fed's told us previously by the end of the year they would do 3 cuts. So once we get to the end of the year, we've got a majority over 50%, at least 2. Probably 3, very small percent, only 1 cut. Got some, more than that, but much more distributed. Again, the Fed's previously said they're going to do 3 cuts. Now, again, not financial advice, but in my humble opinion, I think we'll get 1 by June or July. As you can see, June still has a majority say we're going to get 1 cut by June. Unless, again, the inflation data is unexpectedly high. I expect they're going to cut at least once by June, July. Again, this allows them to appear not political. So once you get closer to the election, I think they're going to probably want to hold off. So again, as to not appear political, again, you're going to hear Powell's going to, stress their data dependency, their apolitical nature, etc. But again, they're going to say they need more data. I expect they're going to want to see a whole year's worth of data. And I think they're going to get that by the June time frame and probably do a small cut in June and then wait and maybe another one in September. Maybe after the Jackson Hole meeting, because again, that gives them an opportunity and a soapbox to explain the data dependency of their decision, and so that again they don't appear political. So I hope that all helps. Again, I'd love to hear y'all's opinion. And, when do you think they're going to start cutting? How fast do you think they're going to cut and by how much, etc. So you can post that in the comments to this video and or in the discussion in our Discord. And again, they pretty much told us higher for longer. Welcome, Tom Poolery. Thank you for joining us. Hope you're doing well. So let's also look at the CME FedWatch tool and see what it says in terms of the probability and the time frame for cuts. So here's the CME FedWatch tool. Again, just another tool, another way to look at the interest rate decisions. So again, we've got a countdown clock again. We can see for March, again, 98% no cut. Go out to May, 94% no cut, 6% one cut. June, majority say one cut, 40% no cuts, 4% two cuts. July, at least one cut, only 22% say none, 30% say two. September, so again, we got 30% one, 40% two, 20% three. And then much more distributed once we get to November. We've got at least, 40% or so say three cuts, which is what they've told us. And then again, mostly three cuts by December. So again, we're not seeing those, in my humble opinion, crazy predictions of 6 or 7 cuts, very small percentage, say more than 3 or 4 cuts. So you can also see the dot plots in the CME FedWatch tool. So we can see where their previous dot plots were, and we'll see how that changes when they release their new dot plots or new SEP this week. So we can see, the distribution, the means, in the 4.5, 4.75 area, dropping down next year to, around the 3.5 area, and then longer term 3. So you can see a very gradual progression down. So, they're not predicting a radical decline in rates. So that whole higher for longer, that's what they've told us. That's what the market should expect. But I think there's been a lot of resistance, and these high indebted companies, that's going to put a lot of pressure on them. Money losing companies, etc. It's going to be higher for longer. So again, love to know your opinions. What do you think of all of this? I hope that all helps. When do you think the Fed's going to start cutting rates now? At what rate? And again, we'll see what comes out on Wednesday. So we've also been talking about how to make money trading in March of 2024. We've got the links to those previous discussions. Also, we're wrapping up the winter. So first day of spring's coming up this week. So we'll roll over from our winter market performance into our spring market performance. And next week, we'll start talking about how to make money trading in the spring. But you can hear how the markets typically perform in the winter and what sectors and industries to look into there. Again, I think the name of the game is sector rotation. I think the rotation in and out of the Mag 7, again, is where the opportunity in general lies, seeing where the sector rotation's occurring in and out of energy, in and out of basic materials, etc. So, again, I hope that all helps. And again, tomorrow we'll talk about dividend-paying stocks and option strategies, but I want to jump back to our ETFs. And again, we have a number of additions to our ETFs Google Sheet that I want to review. And then if we have time and anyone wants to look at any other ETFs, we can do that. So let me grab a quick drink and let's go over some of the additions to our ETF Google Sheet. Okay, just a quick reminder, you can get 24/7 access to our ETFs Google Sheet as well as our dividend payers and our options puts ROIC Google Sheet by joining our Patreon at the all access or VIP level. So again, you can see once we identify a potential opportunity in a futures or in the markets in general, in some index or category, we can jump over to our ETF Google Sheet, find an appropriate ETF to trade them long or short. So I've got quite a few additions that I did the research on this week in the research sheet. So we'll go over each of these very quickly. The first one is gold. I heard about a new one, which is USG, this Gold Strategy Plus Income Fund. So you'll see I also did the research on their dividend payment information. As you'll see, they're a dividend payer. So I wanted to see how this one compared to our other ETFs we have for trading gold long. So if we go to our research tab, go to the bottom, we'll have all the new additions. Eventually I'll sort these in. But here's USG. So here's the risk reward profile on USG. Again, with gold high, we would expect it to be, relatively high. So, much more risk than reward. It's close to its, top. See, it doesn't have a whole lot of risk reward opportunity, but I want to look at it in FinViz. We can see what comprises it. Again, pretty high, as it says, gold's near an all-time high. You can see it pays about an 80-cent quarterly dividend. So it's got a dividend yield of about 7.9, about 8%. So we can see what it holds. So again, it's gold futures, US dollar. It's got some bank reserves. So it's defined performance of physical gold and gold futures markets. So again, this should track the spot gold price and the gold futures price a little bit better than some of the other ETFs that are based on miners. So again, tomorrow we'll also look at the dividend payment analysis for USG. But again, you can then compare USG to the other ETFs, the risk reward profiles for USG to the other ETFs we have for gold. We have quite a few, both up and down. So, and some are based on, futures, some are based on gold miners. So you can see the variety of ETFs we have for trading gold up. We also have, if gold is going to break down and you want to take advantage of that breakdown in gold, you can see the risk reward profiles and the definitions of the various ETFs to short gold. So again, this USG was, interesting. It doesn't seem to have the risk reward profile, even from a dividend payer. We have dividend payers like GLDI, JNUG, etc. That seem to have a better risk reward profile. Again, GDXU is the leverage long. GDXD is a short, Dust, DZZ, GDXD. So number to be able to short gold. So again, I thought it was interesting. Again, the risk reward profile doesn't look any better than the ones that we have. So we'll just leave it and watch it in the research tab. So hopefully that helps. It's something else you might be interested in. Next one I want to look at is another oil one, which is OIH. This is Atlantic Oil Services. This is one that was mentioned by Easy Mike. He also mentioned DBB, which is Invesco Base Metals, and DBC, which is Invesco Commodity Index Tracking. So we'll look at each of those three, and thank you again, Easy Mike, for mentioning those three new ETFs. So again, we've done the research on each of those, and we'll take a quick look at those. So here's the OIH. Again, it's an oil services, so that's an interesting addition to our ETFs to be able to trade oil. So not necessarily the direct oil companies, but those that service them. And in a second, we'll look at their composition. Expected to be, pretty high right now, as oil's been pretty high. Looks like a pretty balanced risk reward right now, a little more risk than reward. So again, it's kind of high. You can see what the short and longer term risk reward profiles are. So it does have some upside. So if you want to play it short term, you could. If we look at the composition. So again, it's bounced as oil bounced back over 80. So you can see where that support level is now, broken out of its pivot point. We'll see again, does oil head up above 80, or does it, is going to just kind of sit at that 80 support level? Looks like this might pay an annual dividend or something, or a special dividend. So we see what it's comprised of, mostly industrial services, some process, some energy minerals. So you can see the companies, so your typical oil services, Schlumberger, Halliburton, Baker Hughes, etc. So again, if you want to be able to trade those oil services, energy services companies, you might be interested in this OIH. So I hope that helps. The other two are this base metals, DBB. So we'll look at its constituents. Again, this is a mixture of base metals. So you can see the risk reward profile for that. Again, right now, a little more risk than reward. Very long term, it's got a decent, but shorter term, it's not all that exciting. You see it bounced up, with that basic materials sector rotation back into basic materials. Still got some upside up to that upper trend line. So again, we started the rotation back into basic materials. Nice run up. If you caught it from that bottom, nice profit. See, it's mostly other. So we see it's copper, zinc, aluminum. So it's a mixture, diversity in some of your base metals. So again, another way to play some of these. We do have COPX, which is the individual on copper. So if you'd like some diversification in some of these base metals, looks like it's got some treasuries, etc. So again, if you want copper, zinc, aluminum, you might like this DBC or DBB. We'll look at its definition. So industrial metals intended to reflect the base metal sector, aluminum, zinc, copper, and it invests in futures contracts. So again, the futures of aluminum, zinc, and copper. So we talked a while back about ways that you can track additional, the futures of additional commodities outside of just FinBiz. So let's look at DBC quickly. So again, you can see the risk reward profile in the research tab. Again, it's bounced up. You can see that double bottom. So it's bounced off that bottom, trending upward. So it looks like it's got plenty of upside, just starting to swing up. So if you'd like to, try to ride that up, look at its composition. So short-term trust. This is pretty diverse. It's got some oil, gold, treasuries, soybeans. So this is a pretty diverse commodity ETF. So track changes, positive, negative, optimal yield, diversity, commodity index. So oils, looks like it's got all kinds of oils, gas, natural gas, gold, silver, aluminum, zinc, copper. So, corn, wheat, soybeans, and sugar. So very diverse set of commodities. So if you want to trade, commodities in general, you think, commodities in general are on a rebound, which does look like that's the case, then this again might be something that's interesting to you. Again, looks like it's got plenty of upside. And again, we are seeing a rebound, rotation back up in commodities. Okay, the last category I want to look at of new ones added to our research tab are some new ones on pharmaceuticals that I heard about in a video by the ETF Guide. So I wanted to look at these additional ways to trade pharmaceuticals. They're both long pharmaceuticals, and then we'll compare them to the one that we looked at last week, which is PPH, to see if one of these is preferable way to trade pharmaceuticals relative to PPH. So we grab a quick drink and we'll take a look at those two additional pharmaceutical ETFs. Okay, so again, in the research tab in our Google Sheet, you can see the one we looked at last week, which is PPH. Now we've got these two new ones, XPH, and which is the Spider Pharmaceuticals ETF, and PJP, which is the Invesco Pharmaceuticals ETF. So we can see how those risk-reward profiles compare to PPH. So we can see near term, XPH looks a little more attractive. 52-week, it seems to be a little bit more attractive. But from a bottom to top standpoint, PJP seems to have the best risk-reward profile. So you can see their current, risk-reward profiles. Again, all these are pretty high. For all these pharmaceutical ETFs are relatively high right now. We look at the charts and the composition of XPH first. So again, we see, ran up with the GLP-1 type news, see a rejection off that upper trend line, broke down pretty significantly, broke down below the moving average. So headed down, right now. I wish I knew of an ETF to short pharmaceuticals. If anybody knows of one, please share that with us in the comments and our Discord, etc. Looks like this pays a quarterly dividend of about 17 cents or so. It's health technology, heavy health technology. This one's kind of interesting. It's got a different distribution of holdings. So you see it's heavy in this Organon, Catalent, Simobay, and then Lilly. So some of the, large tech. This is probably not a market cap weighted one. You can look at that in their ETF database profile. And then they got Merck, etc., Bristol Myers, Royalty Pharma. So we can see total return, pharmaceutical segment, U.S. total market composite index, pharmaceutical selects industry index. So again, total assets. Okay, so part of pharmaceutical sector in general. Let's look at that PJP. So again, very high, although you see this one didn't suffer that breakdown as XPH did. So again, these seem to have some different behavior, different composition. So it's still trending up. Looks like it's broken out. So got some upside. Looks like it pays a 19-cent quarterly dividend, 20-cent quarterly dividend. Same way health technology. So it's, top holdings are AbbVie, Pfizer, Abbott, Regeneron, Johnson. So very heavy in U.S. Based pharmaceuticals. So that may be potentially the difference in behavior. I think some of the other one may have had some European pharmaceutical companies. So again, this gives you another way to trade different compositions of pharmaceuticals with these various ETFs. So I would highly recommend you look at the holdings, look at the composition, the weighting, etc., to decide which one might be preferable for your trading style and how you'd like to potentially trade pharmaceuticals. This invests 90% total assets in the underlying index. U.S. pharmaceuticals. So this one is exclusive to U.S. pharmaceuticals. So that's kind of nice. Gives you, if you want to focus on U.S. pharmaceuticals, this PJP may be a ETF that you might be interested in. So again, I hope that helps. Now we've got 3 different ETFs that we can trade pharmaceuticals long. Again, I'd love to know when to be able to trade pharmaceuticals short. Once we do see the wind come out or the air come out of the GLP-1 theme, that might be a potential opportunity. So, okay, if anybody has, I know I'm run long, had a lot to cover, additions, please let me know what you think of all of this. If anybody has another ETF or category topic you'd like to discuss in our ETF sheet, I'll quickly go through some and we can talk about some more tomorrow. I think we've talked in general. We talked about energy. Talked about the FANGs. We'll talk about these again tomorrow. We looked at Europe. I've been watching these where the risk-reward profile on the Europe and the DAX and the Nikkei and the yen, watching the risk-reward profiles on those. Again, we talked about gold and silver, so longing silver with AGQ. You can see all the ETFs, again, to trade silver, shorts on semiconductors. So again, long silver, AGQ, leverage long. We've got silver miners, silver dividends. We're still long SLVO. Probably get a stop underneath that when it becomes profitable and possibly exit that. Talked about solar at risk due to high rates, so I'm staying away from those. We've got single stock ETFs, so you can trade Tesla long or short. I know there's also TSLZ, which we have in our research tab. I know several of our BeachBum traders made some money on the Tesla short. Same way with NVIDIA. We've got the long and short ETFs for NVIDIA, so you can look those up in our ETF sheet as well. We'll talk about wheat tomorrow. We'll also look at, again, the yen and the Nikkei, and that's another potential opportunity that we've been talking about and looking at. So I hope that all helps. I hope you like this content. Welcome, Pond. Thank you for joining us. Glad to see you here as well. So again, if you have any other questions, any other ETFs you'd like us to do research on as potential candidates to our ETFs Google Sheet, and please put them in the comments to this video, post them in the Discord. Please tag us in the Discord. We're BeachBum Trading, all lowercase, no other characters, numbers, etc. Anyone else is an imposter. Also, we would never DM you asking you for money or to send us crypto or anything like that. So anybody that does is an imposter, and you can let us know and we'll ban them very quickly. But again, we'd love to have you join us in our Discord, and we can carry on these conversations 24/7. Again, we have channels for various topics, commodities, asset classes. So if you have an ETF or a stock you'd like us to take a look at, please let us know in the Discord. Just a reminder, I won't be catching things in other people's chats very much, so please, anything you want us to take a look at, please post it in our Discord, and we'll take a look at that and cover that in another future weekly trading game plan and or a separate video. So again, we hope this content all helps. We hope you like this content. Please smash the like button. Let's try to get the YouTube algorithm to help us show our content to more of our fellow BeachBum traders around the world. And we really need your help to directly share our content and repost our social media postings. Let's continue to build our BeachBum trading community. Again, you can find direct links to our social media profiles in the link section of our homepage, which is beachbumtrading.com. So again, if we all work together, hopefully we can continue to build our BeachBum trading community for the mutual benefit of all of our BeachBum traders. So again, we appreciate all of your support and participation, and we hope you all come back tomorrow at 10 a.m. and we'll cover part 2 of our weekly trading game plan for March 18th through March 22. And we'll take all this information, all this market analysis, etc., and we'll select our top swing trading stocks to watch, stocks in our bullpen and our shopping list. Also, we'll talk about dividend payers and option strategies as additional ways to generate income while we wait for our swing trading stocks to set up appropriately. So thank you again for all your participation and support, and we'll see you all tomorrow. Have a great day.